Hello, this is Mike Swanson of Wall Street Window. I'm speaking with David Skarica, runs the website addictedtoprofits.net. How you doing, Dave?
Good. How you doing, Mike?
Oh, great. Thanks for doing this with me. This is, as we're recording this Wednesday, January the 9th. It's just been a couple trading days for the year, and already the stock market is doing pretty well, and gold is above 1,300 this year too. Gold, the GGX Gold Stocks ETF floating up to 24. But I think people are really much more optimistic this year and bullish than probably any other year we've ever seen, at least according to some sentiment surveys and other information we were actually just talking about before we started the interview.
So I agree totally. This is actually getting almost to the point where you're getting scary, bullish sentiment.
Well,
Extreme.
One of the funny things that came out was Ameritrade releases something called the Ameritrade Index every month, and it's based on how fully invested their clients are, and that indicator is made an all-time high in December. It actually went up a lot in November, the fastest pace up ever in that indicator's history, but it made an all-time high at the end of the year, which means individual investors are more fully invested in stocks with less bonds and whatever, they might, or cash, than ever. Do you think that means the market's going to immediately pull back, or do you think people can go up or things can go up more and more?
Well, here's some of the interesting facts about what's going on right now. As you know, a couple of years ago, Mike and I turned bearish on the markets in 2015. We kind of changed our tone in the last year or so. And part of the reason is that there's certain things that happen before all these crashes or downturns. So right now, the bearish side is this: the sentiment and the valuations are absolutely crazy, right? We're seeing retail investors as bullish as they've ever been. That's a contrary indicator. We're seeing things like stock market capitalization to GDP, price to sales on the S&P back to 2000 levels, right? So we're seeing now these, the CAPE ratio is the highest level other than 2000. So we're seeing these extreme valuations, but extreme valuations doesn't mean you have to have, a bear market, right? So, and I'll tell you, this is what I'm talking about in a second. The one thing that really happens in these bear markets, before, the market starts to roll over, is the internals of the market. So most stocks begin to kind of roll over in the stock market. And a few stocks and the major averages kind of hold up the market itself, and that gives the appearance of strength, but most stocks are not doing well. This happened in 1989. This happened during the first half of 1987. This happened in 1929 as well. So, 1999, not 1989. So, we're not seeing that at the moment. Advanced decline lines, stocks trading over their moving averages, new highs. These things are all holding at strong levels. Now that's not saying there cannot be a correction, and then after that correction, usually there is a correction coming off those strong levels, and then after that correction, those internals begin to lag. So that's kind of what I'm looking for right now, that we have these extreme valuations in the stock market. Basically, if you look at the history of the markets, only 2000 and 1929 right now are comparable to what the stock market is doing right now, but we're going to need to see this internal erosion. And one interesting similarity, you talk about the market starting off strong this year, the Dow is up roughly another 100 points today, which is interesting, is this is the strongest start of the year since 1987. There was an absolutely monster January in 1987. I think the market was up 7 or 8% just that month alone. And then it, zoomed up into the summer and then crashed in the fall. So that's another kind of interesting similarity, that we're starting off really strong, after coming off a strong year, kind of like 1929 or 1987, and then maybe we will see this kind of internal erosion start in a couple months, and then maybe the market starts to roll over in the second half of the year.
Well, that would suggest that right now there aren't any real danger signs, and even if we repeated what happened in 1987, the stock market did go up until August of 1987 before it crashed. So, there aren't any, everything looks okay for now, even though there is wildly bullish sentiment and so forth. Well, let me ask you about two other markets. We'll start with gold. What are your thoughts on gold? I mean, it's back above 1,300, but yet I got to tell you, while everyone's bullish on the stock market, no one really cares anymore about gold, and it seems like whenever it does, pause, people start getting really scared. Some people even calling crashes.
Well, I think actually you've seen an outflow in the GDX and in the GDXJ and in the GLD, over the past few months, even as gold has rallied from, roughly low 1200s to over $1,300 an ounce. And I think that's just a sign of the sentiment that people don't care. As long as you've got, the big, name, FANG tech stocks, the Netflixes, the Apples, the Nvidias, those stocks going higher, and then you've got all these cryptocurrencies really moving. Gold is really not on people's minds right now. So that's not to say that it still won't continue to go higher, but I would think that what's going to happen is that gold and precious metal stocks won't really get the attention of mainstream or retail investors until there's kind of some pullback in those other kind of asset classes, which, people are chasing or people have a high degree of greed on. Like, for example, in 1987, this didn't happen in 2000, by the way, in 99 or 2000, but in 87, the gold stocks were one of the best performing sectors in the market going into that summer blow-off and into the crash. So it doesn't mean that just because the market's going higher and people are complacent, that gold and gold stocks can't go up. But I do think what's going to happen is you're not going to see that retail kind of interest until, if you do kind of get, say, some kind of correction in the spring, and that happened in 87 and 29, before the final move higher into the summer. I think that little bit of a correction and people getting a little bit of fear put into them could put people more interested in the precious metals. But until that happens, it can continue to move higher. But I just don't think you're going to see the retail kind of involvement in that sector until it moves higher. Until the market moves, the higher moving market moves lower.
Well, the opposite is kind of what took place with Bitcoin last year. It's really the retail traders and investors or speculators that got in Bitcoin early, and we don't even have a Bitcoin ETF yet. We do have futures that are trading, but Wall Street itself has put down Bitcoin and cryptocurrency for years, and CNBC has attacked it for years. Also, however, over the last week, I've seen people in CNBC actually positive about Bitcoin and cryptocurrency trading. They have run a segment last Friday on CNBC on Fast Money for about 20 minutes explaining how to open up accounts to trade some of the coins. And last night I watched it too. And again, they had a 20-minute segment. So now CNBC is talking about crypto, and it seems to be like that is where all the attention is. So what are your feelings on that this year? Do you think it can continue higher, attract more new people, or you think it's too crazy?
Well, the thing about cryptocurrencies is no one knows what the hell these things are worth. And even the bulls don't know what the hell they're worth, right? It's just like there's no price to earnings. There's no valuation metrics. The people who are bearish just think it's a bubble. The people who are bullish tell you that it's ending central banking as we know it. It's just like new form of money, blah, 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 right? So, but the thing is, when you're looking at the crypto sector right now as having a market cap of nearly $750 billion, no one knows what it's worth. It's just like, and another thing too is, where could it go? Is it, my feeling all along, it would at least go to $1 trillion, which would still be another 30% move from here. But, could it go to 2 trillion, 3 trillion in a bubble blow off? Who knows? I think there's still too many naysayers out there for this bubble to burst overnight. Yes, the charts, a lot of these things have gone parabolic. But, having lived through a couple of these, bubbles, this really reminds me of the 90s in internet stock, but the late 90s, like the 99 kind of period. It's more kind of early, mid 1999, meaning you could still have another 6, 9, maybe 12 months left. And I think that after this kind of basing here, in Bitcoin, maybe in the 14 to 15,000 range, it can have another surge higher. Because all the guys I know who are bears, every time it drops a little bit, they're saying, see, I told you so, it's about to bust. And I think what happens in these bubbles is that sentiment kind of ends. And then even those bears throw in the towel. Like, if someone who's bearish now at 14, if it goes to 40, is going to be a lot more conservative about calling the bust every time Bitcoin goes down a couple $1,000s, right? So, I think, like I said, it's really hard to know because who knows what the real valuation of all this stuff is. But I would just say my gut feeling for when sentiment it is and the cycle it is, it still might have 1 or 2 more runs to go. With that said, myself personally, I've got like a small investment in kind of a blockchain company that I did in a private placement, and that's really all I have. And I'm talking a small investment, like it's a $5,000 investment or something, right? So it's not a huge amount of money. It's not something that's going to, my feeling on this is this: if the bubble keeps going, this company could go up 5-fold. And, where I'm in the price, I'll probably make 10 times on my money, or the stock completely collapses and I lose 50%. So you look at it this way, well, am I willing to, bet or lose $2,500 to make, $50,000? Yeah, I'm willing to do that. Right? So that's a risk reward scenario, right? So that's kind of the way I'm looking at it. But, in terms of being absolutely sure in either direction, I can't say I am, but my gut would be just from the psychology of it. Everyone is quote unquote not in yet. We're more like 1999 where people think they can get rich overnight. And, you probably have a little ways to go because I think even like another move higher in Bitcoin and other cryptocurrencies to new highs will wash out those bears. And that's how you kind of get the final top.
Well, one thing I've noticed, I mentioned watching CNBC here. I don't really watch it that often, but at the beginning of the year, I tend to do just to see what the feeling is as the new year sets up. And I gotta say, last year, the theme was really the fact that, a year ago around New Year's in 2017, the what was hot and what they were really talking about was FANG, Facebook, and really an obsession over NVIDIA. In fact, I remember the very first day CNBC was on last year, Jim Cramer devoted at least 10 minutes talking about NVIDIA as a must-own stock and all this kind of business. What I've noticed, though, just watching it the past week, is there's been very little mention of FANG. I don't think I've even heard them use that acronym once. And instead, I think it's Bitcoin and crypto that's kind of taking the place of FANG as being the fascinating thing. So it's really interesting how CNBC is reflecting what's going on with people in the markets. But
well, what is your opinion on that? Because my opinion is, it's still media, right? And in our industry right now, what we're seeing is, I think Mike and I will be pretty honest with you, is that after the election, when the market really went straight up, and now you've got a year going straight up without a correction, it kills the newsletter industry. Because what happens is, just like it's killed the hedge fund industry, because what's happening is people are moving into passive investments. They think they can just be long and not have to worry about declines. They don't need advice because all you have to do is put your money into some cryptocurrency or the FANG stocks or whatever, or an ETF or whatever it may be. And CNBC, their ratings are back to the lows of when they started the network, in the early 90s. So I think basically there's some producers pounding the table and smacking some of these guys in the face and saying, hey, you got to talk about Bitcoin. You got to talk about cryptocurrencies because that's how we're going to get ratings again, right? So I don't think it really has to do with even these people believing in it, but it has to do with more ratings. And in our industry, just to get back to that, We've seen that as well. A lot of people we know that have stock trading newsletters, or that were purely like, say, precious metals based or commodities based or stock based or whatever it is. They've gone to now trading cryptocurrencies because that's the one area where you can probably sell newsletters at the moment. So I would say a lot of that is marketing orientated, right? And the same thing happened kind of in the 90s. Like in the 90s, CNBC was all bullish on stocks, but they weren't really all about internet stocks until 1999, when they knew that's what people were interested in, and that was what they had to promote to essentially get viewers.
No, I think you're absolutely right. I mean, I do think that the people that are on that network, Jim Cramer and the Fast Money guys, I do think that they, were owning these FANG stocks and bullish on the FANG stocks, but I don't think they care at all about cryptocurrencies. And I think you're right. I think they're just forced to do this to keep their audience, basically. And really, honestly, I don't, I find CNBC fairly boring. I don't really care about their opinions on individual stocks. So to me, it is actually myself more interesting to hear them say something about a cryptocurrency I don't need to hear Jim Cramer say how great Facebook is. Again, he said it, over and over and over again, in Apple too, and all these stocks. I think no one really cares anymore about these stocks. They own them and whatever, and they want something new, and that's where crypto is. But
if you want the classic example of kind of how Cramer does things, how he thinks, what happens in a bubble, is actually remember this vividly. It's funny how you remember little things like this. But in 2005, I visited the Bahamas before I moved there, and you and another friend of ours were coming down to visit me. While I rented like a townhouse, and we're all staying together. But I was there alone for a few days, right before that happened. And I remember I was watching Fast Money, and Cramer every night used to pump a stock, and still exists. But now it exists because everyone knows it's probably going to go bankrupt, called Sears Holdings, right? And of course, Sears Holdings is Sears. They have a whole bunch of real estate because of all the stores they own all over North America. Actually, Sears Holdings of Canada, the Canadian arm, went bankrupt a few months ago. So anyhow, but he would just pump it, saying, it's so great run, it's great, it's this and that, real estate. And, because then was the real estate bubble, and on top of, having all these stores, Sears Holdings, probably value of the real estate they own was skyrocketing in the mid-2000s. So he would go on there and pump it every night, and whatever, the stock's 150, it's 180, it's 210. I think it eventually topped well over $200 a share. Well, Sears Holdings is now a single-digit stock. He never talked about it at all. And that's just an example of what goes on in these bubbles. And it doesn't matter if it's a cryptocurrency, it doesn't matter if it's Netflix or one of these FANG stocks, is that for years and years and years during the bubble, these things can stay overvalued, right? But then when it crashes huge, you're going to lose 80, 90, 99, 95% of your money, and then the thing is just going to wallow for years. So that's kind of, what's, going on with them pumping all this stuff too. It's like, you're right until you're not. So, someone who's been pumping Netflix for 2 years or 3 years has just seen that stock go straight up. But when that bubble bursts and high valuation stock like Netflix crashes, the thing will go to $20 a share in a bear market. And then, wipe out years and years or even a decade of gains. So that's kind of what happens, and that's the mentality. And that's why I don't want to watch it either, because I just know they're going to pump the same stocks every night. But you're like you just said, yeah, I'll watch it if they talk about cryptocurrencies. Why? Do I really care about cryptocurrencies? Not really, but it's more entertainment. At least they're talking about something different, rather than just, talking about how great Apple is, every night.
No, it is what it is. Well, as we wrap up this first segment for 2018, do you got any last thoughts or anything you'd like to say?
Like just to bring this full circle, you said, "What are you doing?" Right? Like, there's this bullish sentiment. The market is overvalued, but on the other hand, it doesn't look like in the short term we're going to have a major market decline. Could we have a correction that begins the internal erosion? Yeah, sure. That kind of happened in March of 2007, happened in the spring of 87 and early 1929 as well, right? Or happened in mid 1999. So the thing is that you think about that, right? what do you do? So what I've done in the last year or two, when I came to the conclusion in 2016 that, I've been bearish for like a year. I don't think this thing is going to crash overnight. So here's what I'm going to do. I have access to financings because I used to travel around all the time. I know a lot of people in the small and micro cap industry, and these range from blockchain and technology stocks to marijuana companies to gold and precious metals to base metal mining, whatever it may be. So I'm just going to put some money into these early stage seed or angel kind of investments and then wait 6 to 9 months for them to trade. And usually they trade at quite a premium to that, early round to financing. And then I'm going to hedge the position with put options. So if I buy a copper deal, which me and you own this copper deal, and they're just about to close the first round, what I'm going to do is say put 10 grand in this copper deal or whatever it may be. And then I'm going to buy a couple $1,000s worth of puts on a large cap copper company or even on, maybe the copper ETF or something as a way to hedge the investment. So that's kind of what I'm doing right now is putting my money in these deals that will continue to do well as long as this no volatility overvalued market continues. But then I'm going to hedge with put options because that way if everything falls apart, at least I've probably make enough to at least get back my original investment and maybe more. So that's what I'm doing right now, and it's not like really sexy. Actually, I shouldn't say it's not exciting because it is exciting because many of these stocks can come out 5 or 10 times their value. So I shouldn't say it's not exciting, but that's what I'm doing, and it's more kind of market neutral, right? Where I've got the put options if the market goes down, and I've got these deals if everything keeps going the way it is. And actually, there's an interesting note on this just as we end here. Mike and I did this gold deal a few years ago, and the stock did nothing for years, and it's just really, run up recently. And basically, now basically the warrants that we have in the deal are in the money. And if you bought the deal a couple of years ago, you'd be up 50% right now. And that just shows you, why you do these things. And the great thing about the warrants is if this stock continues to run, you can make 100, 200, 300% just in the warrants, exercising the warrants, with the stock going up. So that's a great thing about doing these deals too, is it doesn't have to move overnight. It could take years and you can still make money.
Oh, for sure. And, it's not been that long ago. I mean, you're talking about something that we got into,
it was about 18 months ago.
Yeah, basically. And the way to do these deals like this, you're kind of like being a venture capitalist in a certain sense, and you've got to spread out multiple ones, right? So you buy, you want to buy 10 or something, and not put all your money in one thing, just like you shouldn't put all your money in one single stock for that matter.
Well, the idea is kind of like this, that if you buy 10, 1 or 2 or 3 might really take off. Another 2 or 3 might do okay. Another 2 or 3 might do nothing, and then another 2 or 3 might completely tank. But it's just the basic math, right? If you got something that goes up, and this can happen in these 10 times in value, well, that means if the other 9 went to 0, you would still double your money. Right? So that's kind of the whole idea that, like you said, you spread them out and hopefully a couple do really well. And then if a few of them just do nothing, and chances are, I'm assuming that those other 9 went to 0, right? But, chances are the other 9 at the worst case scenario are going to do nothing. And if the other 9 went to nothing and this thing went up 10 times, you would do really, really well. So that's kind of the idea behind, the whole, doing these deals. And the warrants really help you, because let me just explain quickly how the warrants work. So let's say, a seed deal is a little different because usually you're in on a cheap price. So you'll buy a stock of 5 or 10 cents. The stock will come trading at 40 cents or something like that. And you're not going to get warrants associated with that. But, you're going to have a good gain. But the ones with the warrants, the way it would work is, if you say bought a stock at 10 cents with a 15-cent warrant, and I'll give you an example. This basically a stock that did this that helped me, get the down payment for my house. Was, I bought a stock called Tinka Resources way back in 2010 or 11, and the stock was 10 cents. The warrant was 15, and the stock went to about 50 cents. So let's just say, for argument's sake, I had 100,000 shares, right? Well, that 100,000 shares at 50 cents, 10 grand becomes 50 grand. Well, then you can turn around, sell some of that stock at 50 cents, use that money to exercise the warrant at 15. You got another 100,000 shares then, and boom, you got 200,000 shares, or maybe a little less, maybe like 150 after you sell, to exercise the warrants. You got 150 at 50 cents. You got $75,000 really on a $10,000 investment, because you're just recycling the profits to exercise that warrant. So the warrants really can give you leverage, where if the stock, say, goes up 3 or 4 times, you can actually make 7 or 8 times on your money.
No, that's why it's it's so exciting, as you said. Well, thanks for taking the time to talk to me and everyone else, and we'll talk again soon.
Yeah, thanks for having me.